Hey everyone, happy Tuesday. Welcome to the final bar. Today we're going to talk market recovery, market rally. I love how every day or two we can completely change the vibe. Maybe we'll change the screen color in the background from green to red depending on what's happening. I joke, but plenty of volatility still with consumer staples actually emerging number one today, followed by technology. So the question obviously is it more the recovery story or is it the banks and others that are struggling on earnings? We'll have to see. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close. Break down the day's price action, take a look at the technical themes, trends emerging around the markets, and focus on connecting the short term of today with the long-term trends that are so important to us. And today, obviously, markets back in recovery mode. It's obviously tons of speculation about economic recovery and how things are going to reopen, and certainly the vibe today was one more on the recovery side. It's interesting though, there's that juxtaposition, as I mentioned at the very beginning. There's this juxtaposition of this confidence that things are going to continue to get better, things are going to get back to normal at some point, versus some of the banks that are recognizing the pain that this is causing to their businesses and coming in with numbers that are pretty weak. So you've got this weird sort of conflict between the two. And the question I think we're all trying to figure out is which one of those themes is going to play out more and is going to be more something we have to worry about. We've got a lot of great guests helping us today. We've got Brian Shannon from Alphatrends who's going to join us in a bit to give his take on what he's seeing, which I'm really excited to hear. Tomorrow we have Trevor Neal from the Beta Group joining us from London. And on the 16th, on Thursday, we have Willie Delwich from Robert W. Baird, strategist there to give his take. Also wanted to remind you, tomorrow and Thursday, we have our special event, our latest documentary style program called The Big Board, behind the scenes at the NYSE. We had a great visit to the New York Stock Exchange with our friend Jay Woods. This was in December, and our production team, Gretchen and others, have done such a good job of putting together the stories that we uncovered, talking with Jay about his role, the floor, how it's evolved, what the market makers are doing, how they use charts. You're really not going to miss a behind the scenes look at how they think about the markets and through the lens of charting, through the lens of technical analysis. So some really good stuff coming up on StockCharts TV here. Let's get to a market recap, and the S&P finishing strong today and really a big move up out of the open, and then just sort of this consistent upward pressure building through the day. And this was one of those days where I could see, in previous sessions over the last couple of weeks, it's been this nice run, and then it gives it all back going into the close, or a lot of it, and all of a sudden you have this, this sense of foreboding, like something's not quite right, that we can't finish strong. But today, certainly, it seemed like we did, right? Finished near the highs of the day with the S&P around 2846, mid caps and small caps up a little less, around 2.2, 1.8% respectively, but still, again, in the positives. That's worth noting. The VIX now below 40, which is, it's been so elevated for so long. And again, still, based on this historical averages, this is still pretty far above where it normally has been, but certainly down a great amount from the peak when the VIX is getting 60, 70, 80-ish, accelerating to the upside. Let's look at a chart of the S&P, just how things played out. So as we've talked about in the last couple of weeks, really, right? When we're in sort of bear market rally mode, which I still think we are, the concern for me, and I think any technical analyst, is just the question of how much of that sell-off we can retrace. And, anecdotally, again, my job is not to be a macroeconomist or a geopolitical expert or a medical expert or any of those things. My job is to understand charts and help you understand them too. But the question I would ask as an investor is, do things deserve to be back up where they were when everything's fine and there are no issues? Clearly, it seems like we should be at a different level of valuation, a different equilibrium where buyers and sellers would imagine it makes sense as we, this is going to be a slog of sorts just to, even if things go back to quote unquote normal today, that's a process, right? It'll take a process to do it. Do we deserve to be all the way back up here? And I can't imagine that that's the case, which means at some point along the way here, that's been enough of a run and you'd expect more of a digestion. And the best case scenario, I think, is more of a backing and filling, sort of taking some time, making sense of where we're at and sort of understanding as the headlines evolve, or things get a lot worse. And all of a sudden we're going back and we're looking back at previous lows and looking at key support levels. And, again, I don't know what's going to happen. No one really does, but I do know, looking at lots of charts over many periods of times, that we're about at a 50% retracement, which is just above 2,800 if you look at the sell-off from February to March. More often than not, a big bear market phase will have a nice big 50% retracement. We're kind of there. Now, today was more of a follow-through to the upsets. It really felt like we're continuing this trend. Again, I'll remind you, my trend follower brain would tell you, as long as we keep making higher highs and higher lows, the path of least resistance is up, and you have to assume that's going to continue until you see evidence that it's not. So the warning sign, what puts it on my level, is that we've hit that level of resistance, this blue shaded area, which is a 50% retracement. It's also going back to the lows that we saw last August and last October. So, the question now, how high do we get? The RSI just below 60, which in a bear market phase, that'd be a pretty logical place for a bullish move to exhaust. Again, we'll have to see, and again, keeping an eye on the highs and the lows and whether they continue to move higher. Let's continue to unroll some of the themes we saw today. So with that nice sort of up move in equities, bonds actually came off a little bit. They rallied and were in the positive there midday around lunchtime, came back and just got right about to flats at the TLT, sort of ending at a similar level, and the 10-year yield up just a token amount, but not too much. Gold continues its relentless uptrend. This is one of our 3-on-3 yesterday, this nice up move in gold, which seems to consider. You can juxtapose that with some of the energy related ETFs, which were down pretty big today. Oil, natural gas down 5% a piece, and so on. Bitcoin, again, I used to think of Bitcoin as the quote unquote the volatile one, the cryptocurrencies, but I feel like there's so much volatility elsewhere. You don't have to go there just to get a sense of where things at, but Bitcoin just still below the 7,000 level, but rapidly potentially approaching that key big round number. In terms of just breaking down the equity universe to wrap up, and then we're going to go on to our mailbag. Technology was the number one for a while. Consumer staples actually overtook it, up just over 4% for the day, followed just closely by technology, also up about 4%. Consumer discretionary number 3. So it was all consumer and tech at the very top, followed by healthcare. At the bottom, we have energy, the big loser. One of our 3-and-3 relates to the energy sector, so it'll be interesting to show you that one. Financial second from the bottom, and this, this sort of makes sense. Energy has been challenged for a while, and oil prices coming down certainly not helping. With the financial sector, we're into an earnings week here, and I think today you're starting to get some of the larger financial institutions recognizing the impact of all of the shutdown and expectations on their earnings, on their books. And so, again, I think there's more of that to come through the course of the week as we see other stocks starting to report here. I did want to note, looking at the scooter rankings, and again, yesterday we had a fun session on shifting stocks. So if you missed that, go to our YouTube channel, check out yesterday's show, because we went through a lot of different sectors and themes and individual charts to reflect on. We rarely have enough time to get through all of that in a quick show like we have here. I did want to point out Newmont Mining, I think, had a 24-hour run as the number one stock in our scooter rankings. It may well get back up there, but number 2 behind AMD, which emerges our number one stock. Again, according to his StockCharts technical ratings, a trend following percentile ranking, looking at all the charts. And it's interesting, the chart of AMD reminds me a lot of the chart of Netflix, maybe the chart of Amazon, where it's this sort of pullback and then recovering, aiming back to that previous high. So Netflix yesterday just finally really pushed through that significant resistance. AMD a little bit below there, but a break above 59, getting above that high from mid-February would be a significant breakout. And you have to like the relative strength, right? Up 100% relative to the S&P over the last 12 months, with much of that coming in the last 6 months, to be honest with you. So AMD has certainly been getting it done on the positive side. In terms of ETF, actually, the S&P was one of the top global ETFs. Most of them were up a little less, very few down on an absolute basis. Russia was the only one in our basket doing so. Looking at the industries, actually, it was interesting to see on the top 10 list, you have a lot of consumer groups represented, almost all of them actually, and those, number one, number three are the two consumer sectors just today, and then technology as well. But if you look at the individual group levels, things like hotels, gambling, recreation products, broadline retailers, recreation services, autos have been up here pretty consistently. Some of these other ones are not often participants on the top 10 list industry-wise, and these were all up 4.5+%, up to 7.5% for recreational services. So a number of groups up pretty meaningfully. In terms of the groups that were hurting the performance, kind of a lag, it's the financials, it's the banks. This is some earnings announcements that came out. It's also a lot of the energy groups down here. So equipment and services, integrateds, the E&P stocks, all sort of on the bottom. Gold miners, I mentioned Newmont Mining coming off the number one list, and that group here within materials up just a small amount, but overall relatively muted. Just to wrap up this segment, I just did want to point out a couple quick breadth charts, and we don't have a time to look at a lot of these. I think the cumulative advanced decline lines continue to improve. This isn't updated for today's close yet, but it is putting in higher highs and higher lows. That's been one of my concerns as you see the market rallying is, hold on, unless we get an uptrend in the advanced decline lines, I don't know if this is really believable, and it certainly seems to be. I mean, it certainly seems to be plenty of momentum. This is the one that concerns right now, though, and it's not a concern, but more just, I think, demonstrating the characteristics of where we're at. As the S&P has rallied about 50% retracement of the February to March sell-off, it's worth noting that there's still essentially zero stocks making new 52-week highs. So, there are a couple. It's the Netflixes and others that are way up at the top, Newmont Mining, Gold, others that are up there. But most things are sort of down in this middle range. So even though we've recovered off of the lows, we're still down a big amount from the previous highs. That hasn't changed. You don't have a ton of stocks getting to new highs yet. If that number starts to improve, you start to see things start to build up, and that would be more like the first couple months of 2019 after the lows there. You saw after a little while, you saw some new highs creep up as stocks were able to eclipse the previous highs. That's what I think we'd be looking for if you want to sound some sort of all clear. Not there yet, folks. We need to move on to the final bar mailbag. Got some great questions that you've sent in. Thank you all so much for sending your questions and your feedback. We'd love to hear from you and answer your questions in a future segment. Did want to start with a poll. We ask on our StockCharts TV page. Always we have some sort of poll open, trying to gather some feedback from you. Also on our YouTube channel, we're opening some polls as well. We recently asked you, what sounds most painful to you? Being out of the market as it goes to new highs, being in the market as it goes to new lows, a market that goes sideways, or none of the above, I'm a robot, no emotion, doesn't bother me. So 8% of you, congratulations, you have evolved as completely 100 robotic disciplined traders and investors, and emotions mean nothing to you. And probably I'm saying that very much tongue in cheek. I don't think you ever get away from it, but certainly managing them can be helpful. I thought it was interesting. Over almost half of you announced being in the market as it goes to new lows is more painful, basically, than being out of the market as it goes to new highs. So the FOLE, the fear of losing everything, right? The fear of losing on the way down is more palpable than the FOMO, the fear of missing out on the previous highs. And it's interesting, if we ask that during different cycles, bull or bear market cycles, you might get a different answer. But I'm not super surprised by that. I think we still have that fear of the market going down. And for any of you that have been investing over 10 years, you remember some of those historical periods where things just got absolutely crushed. And if you're on the wrong side of things, boy, it does not feel like it could get much worse emotionally if you get too tied up into it. So that certainly recognizes what the academic research has certainly shown. So thanks for answering that poll question. Really more of a behavioral angle today, which I like. All right, we've got a couple questions to get through. I'm going to get through as many as we can right now. First question: it seems you're expecting another downturn in the S&P and NASDAQ, but with the Fed buying all assets, which has not happened in the past, do you think technicals matter anymore, as the Fed has unlimited power to buy stocks, high yield bonds, and junk bonds? Why would stocks fall at all when the Fed is buying at any weakness? I think, I totally hear what you're saying. And I think the argument is in some ways, right, depending on who you ask, I think that's fueled a lot of the last 10 years, depending on where you start the clock. You could argue that, federal or central bank support is one of the things that's allowed, the market to go up, all the QE and everything coming out of the financial crisis. Certainly, there's no denying that had a positive impact because you're injecting demand into the system, you're withdrawing supply, however you want to think about it. There's that. There's also corporate buybacks. You had managers, companies buying back shares, which I think created a lot more demand than people think. So, we simplistically think of the market's driven by the supply and demand of investors, but remember, it's the supply and demand across the board. And there are a lot of ways to change the supply and demand picture. Central banks have one set of levers that they can bring to bear. Companies can buy back their own shares, reduce supply, and that will buoy the shares. The question is, how perpetually sustainable is that Fed buying, and is it in their best interest to continue to do that? I think that's the real question, right? The concern that a lot of people have, strategists that I know, talking to like Tony Dwyer and other guys that know way more than I do, Gina Martin Adams from Bloomberg, will tell you that certainly they have been able to provide that quantitative easing, but at some point it's not in their best interest to do so, because you're creating bubble-like environments when there's this this perpetual put in the market, right? So I think the plunge protection program is what comes to mind there. So yes, certainly if the Fed keeps buying, that could certainly buoy shares. The question is whether that's going to do. And also buybacks, which I mentioned, are kind of going away. So I think that's reducing a big piece of demand that we've had historically. Great question. Second one, I frequently talk about my S&P 500 chart list that has the stocks in sector and then industry order. How do I do that? Yeah, no problem. So if you go to your member dashboard, you go to your list, and it's easy to create a list with the S&P stocks. I'm not going to go through and recreate it, but just create a new list and say, copy the members from an index. So basically this works on different sorting mechanisms. So it's kind of up to you on how you want to sort it. What I did there was I clicked on industry first, and then I clicked on sector, and it magically puts it in this order, which is starting with the sector first, and then the industry after that. Once you start messing around with it, at the very bottom, there's this thing that says number in sorted order. It's kind of hidden in gray, but it's an active button. If you click that, it's going to reorder your whatever you did there. It's going to put it in a new order reflecting on the new way that you've sorted it. So that's another way you could sort things on Scooter rankings, and then resort the list by this, dump it into a chart list, and start flipping through the charts. Same way you can do it. So that's the quick version. Sorry if that was super quick, but hopefully you followed what I did. It's all about just resorting and then saving in the new order. The next one, if only a handful of names carry the weight of the S&P 500, should you use an equal weight ETF like the RSP as a gauge or signal in a downtrend instead of the market cap weighted SPY or vice versa? That's a really good question. I created this chart as a result of reading your question a little earlier, and I think that's a great idea. I actually have this chart on one of my lists. I rarely show it, and probably just it's slipped out of my mind. This is a ratio of the RSP to the SPY. So it's a ratio of the equal weighted S&P versus the cap weighted S&P. The idea being, if this line is going up, the equal weighted version is outperforming the cap weighted, which means it's bringing down the weight of those big mega cap tech consumer sort of names that tend to dwarf the rest of the smaller names. And it brings up the weight of the smaller end of the S&P 500. So if that's going up, the average stock is doing better than the mega caps. If it's going down, the average stock is underperforming the mega caps. And this chart speaks to the phenomenon you just pointed out, which is, you're right, for a while now it's been mega cap driven, and that's why this ratio has gone lower, because the mega caps have been outperforming the middle of the road, basically. You can see this potential change of the guard, and I think that's a really interesting chart to watch going forward as we wrap up the mailbag here. Whether this ratio goes higher, which tells you the equal weighted version is doing better, which means some opportunities are outside of the mega caps, which would certainly be a very different environment that we've seen for quite a while. Those are great questions. Thank you all so much for sending those in. We'd love to hear from you all again very soon. We're going to take a quick commercial break. Back with my friend Brian Shannon from Alphatrends. We'll see you in a minute. Hey everyone, welcome back to the show. I'm Dave Keller here at StockCharts.com. Please keep your questions, your feedback coming to us. We'd love to hear from you. via email, thefinalbar@stockcharts.com. We get a lot of great questions about Stock Charts, the platform, about technical analysis, about market history, about behavioral finance, whatever you want to ask. We'd love to help you navigate through these times, point you in the right direction. So shoot us any questions anytime. Also on Twitter @FinalBarSCTV. I want to bring on my guest, Brian Shannon from Alphatrends. We had such a great time sitting down with Brian. I think it was at the Money Show, and loved hearing about you. Actually, it was the Traders Expo in Las Vegas, Brian, I think, right?
Right, back in November.
Yeah. And it was such a fun conversation. I loved remembering. I mean, sitting down with you reminded me the idea of multiple timeframes that I've thought about a lot more since our conversation. So thanks again for what you've written and what you've shared with everyone for this. Thanks for sending 2 charts, by the way. The first one, a weekly chart of the S&P, and break this down for us.
Yeah, well, again, just to frame the bigger picture with multiple timeframes, I'm more of a swing trader, but I of course have to be aware of what the overall environment is that we're in. Right now, we've just rallied 30% off the lows in the S&P 500, which is just amazing, right? But what we're looking at here on this chart is a couple of anchored volume weighted average price levels, those what look like moving averages, which essentially they are. They start at a specific place and they tell us the average price the S&P has traded at since then. So if you look at the blue one from the December 2018 low, you can see we just hit that today. That had previously been support, and it tells us the psychology of the market since that big washout move was made in December of 18. And you can see that, in February, we tried to find support there. But now we're at that level again. It has the potential to become resistance. I also anchored them off of the highs, the 2 highs in 2018. That's the pink and the red. And then from that last touch in June of those 2 volume weighted average price levels, you can see those are right ahead. So it's telling us we're coming into an area of potential supply, as you pointed out, and a lot of people have. We've just gone beyond the 50% retracement from this, from the drop to the low. We're above the year-to-date volume-weighted average price. If you switch over to the shorter-term time frame now, and you can see on here, this is constructed of basically hourly charts. The blue one is the year-to-date volume-weighted average price that acted as resistance last week. Today we're holding above it. I've got a 5-day moving average, which is the orange line. And that's I try to trade in the direction of that, Dave, the 5-day moving average. As long as we're above that and it's rising, I look at the intermediate term trend as innocent till proven guilty. So then you look at it and say, okay, well, if the intermediate term trend is innocent till proven guilty, how does that fit in with this bigger picture where we have the potential that we're running into, a potential area of resistance? And it's about, knowing your time frame and managing risk and saying, I'm going to give the benefit of the doubt to the intermediate term buyers in here, but I'm going to be aware for signs that maybe we're going to start to reverse lower. And right now, there just aren't those signs. We closed at the highs once again today.
It's fascinating. The 65-minute chart, I think I get the idea of it, but I think it's a time frame that I've not heard others on Stock Charts TV using a ton. Can you just talk briefly, why focus on the 65-minute, and how do you look at that relative to other periods like the daily and even shorter term then?
Yeah, so the 65-minute time frame is simply, you can break it, there's 390 minutes in a day. If you divide it into, by hours, there's 6.5 hours. So each candle, we would have 6 candles that are 1 hour long and one that's 30 minutes long. So rather than comparing six apples and 1 orange, I want to look at 6 apples or 6 oranges. So there's 6 65-minute equal length periods of time throughout the day. So that if you have a stochastic or if you're looking at an average volume or whatever, it's not weighted, front loaded. Basically, you would be getting twice as much information weighted to that first half-hour candle than any other candle, which isn't the right way to do it, in my opinion. So it's kind of geeky, Dave, but to me,
that sounded like a great justification, though. I get it. No, that makes sense.
So you could go with 30-minute charts too, and that there's 13 of those that are equal length per day. Yeah. You could go with 130 minutes, which there's 3 of each period, every day. So that's, again, it's kind of geeky, but that's how I look at it.
So we only have about 30 seconds left, Brian. These are two great charts. I'd love to know, so we have this idea of, on the long-term trend, we're approaching this key supply area, right? This resistance area. The short term, though, the intermediate term, what you described, the 65-minute chart, sort of in go mode, right? Sort of in a positive trend. What would you see that would maybe signal that the short-term top is in place and we need to play more on the downside? Is it breaking down through a 5-day moving average? Is it breaking down through a support level? What from your toolkit, what would be sort of a go-to thing you'd be looking for here?
Kind of a combination of those. That's so when you look there, you can see that little consolidation right at about 274. From yesterday and last Friday, and the 5-day moving average is down around in there as well. What I'd like to see, if we're going to roll over, is we break this pattern of higher highs and higher lows that's very clear to see over the last 2 weeks, and then the 5-day moving average starts to flatten out. Then the market gets trapped underneath that 5-day moving average and makes lower highs and lower lows below the 5-day moving average. So I'm not looking for the exact turning point. I think there's a lot of reasons. We've got the measured move up in here. We've got a declining 50-day moving average we're coming up upon. There's a lot of reasons to say, be ready to be more defensive. But right now, raise your stops and don't look for the peak quite yet, but just be aware it could be showing up in here, sometime in the next days to weeks if it's going to reverse.
Brian, that's a great take, and I love how you wrap things up right there. Really appreciate you coming on. Stay safe, and would love to have you back on down the road, all right?
Great. You too, Dave. Thanks.
All right. That was Brian Shannon from Alphatrends joining us from Colorado. And again, as I mentioned to you, I think we're so blessed on the show to have really knowledgeable analysts, strategists, traders like Brian and others. And what I always appreciate is his toolkit looks a little different than mine in a lot of ways. And I think that's what's so helpful about what we do as investors, is learn from others that have a different take. Their toolkits have evolved differently, and see what you can learn from as many people as possible. What is great couple thoughts there. We need to wrap up the show, folks, and go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the U.S. versus the world, and the way I usually look at this is the SPY, the spiders, versus ACWI, the All Country World Index. So that's sort of a global equity index. It includes the U.S. So it's about 50% U.S. and 50% non-U.S. And just an overall way of simple ratio showing you, is the U.S. outperforming or underperforming the world? We've had a couple pullbacks here, and the second half of March, you really saw the ratio come down. And the question was, oh man, are we going to get a weaker dollar environment? Are we going to see the U.S. really struggle on a relative basis? What's interesting is in the last couple of weeks, that ratio has once again turned more positive now, again, to long-term highs, right? Breaking above the peak from mid-March. So even though the S&P is still well below its previous highs, this ratio, looking at the U.S. versus the rest of the world, essentially in a position of strength and improving from here on. Chart number 2, we mentioned earlier in our market recap, looking at breadth in a couple different ways. And one of the charts I showed you was this, looking at the 52-week highs for the New York Stock Exchange and the 52-week highs for the S&P 500. I think it's interesting to note that even though we've had some stocks that are sort of at that new high thing, if you think of the stocks in the top of the scooter rankings, that's like the AMDs and the Regenerons and the Newmont Minings, Netflix, these are stocks that are at or near, all-time highs essentially, or breaking out of long-term bases. But I think it's worth remembering that the average stock essentially is nowhere near there, or certainly has not eclipsed it yet. So even with this nice rally out of the lows, we're still pretty far off the previous highs. And I think there's a lot more to be done before we can feel like things have gotten completely better. If there is an improvement on there, I think that's where it'll be interesting to start to look for which of those names are able to eclipse the previous highs. And finally, this actually comes from the mailbag. I was going to make this one of the answer it as one of the questions in the mailbag. It was such a cool chart idea. I set it up as one of the 3 and 3. So thanks so much for sending this in. I had showed you a ratio before of technology versus financials and talked about that relative underperformance of the banks and the other financials. Here we're looking at energy relative to technology. Look at how energy has clearly underperformed for quite a while. But in the last 4 weeks, look at how this ratio has actually turned higher. So energy's actually been the juice, outperforming tech. And here's an equal weighted version at the bottom. Problem today is we've just broken down through that trend line, suggesting a rotation back away from energies. We'll have to see if that continues. Thanks so much for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.